Alright, this is Lecture 10. It's on Chapter 10, which is Cost of Capital. In the last chapter, Chapter 9, we looked at stock valuation, and we really just looked at one model. It's the Gordon growth model, or the constant dividend growth model. We'll actually just look at one model on this chapter as well. It's called the weighted average cost of capital model. This one will be a little bit more involved. There's more steps involved, so it'll take a little more time, but we're really just focusing on this one model. This chapter by itself is really not that exciting, but this concept of cost of capital we'll use in later chapters. So we'll use it in the next chapter on capital budgeting, and then if you wanted to read ahead, we're not going to have time because of the short semester to cover the entire textbook. But if you wanted to read on to some of the other corporate financing decisions, like capital structure decisions, where you decide how much debt versus equity do I want to have. Basically, you look at the right-hand side of the balance sheet and decide what mix of short-term, long-term debt, equity. The general decision rule there is you try to mix them so you minimize your weighted average cost of capital, so you would use this concept there. It also plays into payout policy decisions, working capital management. So this weighted average cost of capital is used in several other decisions. But in this chapter, we're just going to learn how to calculate the basic metric. So it's really just arithmetic work. It's a weighted average. Just like any weighted average, you sum over a weight of each data item times what you're averaging. So in this case, we're averaging the cost of different forms of capital. So you could break this out. You could break the right-hand side of your balance sheet into as many different kinds of capital as you wanted. You could have short-term debt, long-term debt, preferred stock, convertible debt. Could have, and then equity, common equity. We'll usually just work with two items. We'll keep it simple so that you basically have two forms of capital, this long-term debt and equity. And so we're going to be averaging. We're going to look at the cost of each of those individually first. So we'll need to look at how do we estimate the cost of debt, long-term debt, how do we estimate the cost of stock, and then you find the weight, which is the percent of total capital each of those, multiply them and sum. So it ends up, if you just have two items, looking like this bottom formula. So this is more general, so you can put as many different types of capital in as you wanted, but we'll just use this two item one. So basically this is a straight weighted average. You have the weight of debt, you have the weight of equity. Those two weights have to add to 1. So if it's 50-50, that means you raised half of your assets you raised by issuing equity and half by borrowing money. It could be 25-75, 75-25, 30-70. They just have to add to 100%. And then you'll have your two costs for the two individual types of capital. So there's a certain amount you have to pay your equity holders back as a percent. So this will be a return, like maybe you're in the last chapter we actually figured out how to use that constant dividend growth model to get a cost of equity, essentially. And we'll do that again here. So you can look at, as a percentage basis, what do we need to pay out to our equity holders to make them happy. You do the same thing with the debt. There's one little wrinkle in here, and that debt's tax deductible. But alright, so this is our basic formula. We'll start with estimating the cost of debt. Okay, so for starters, we're going to look at how we estimate the cost of just the debt portion of our balance sheet. So essentially what we're doing is we're finding the cost of our whole balance sheet, but we're breaking it up into parts, and one at a time we're going to find each of their costs. So this is how much we have to pay shareholders. So for debt, debt's quite a bit easier to do than equity, because debt has predetermined cash flows. You go back to the bonds chapter, and we actually did all this already, where you can back out a yield to maturity on a bond if you know its price. But there's really two ways you could do this. Ideally, if you're a company that has a lot of debt instruments that are already trading, then you just go out and look at, well, what's the yield to maturity on those outstanding debt instruments. So, but in reality that doesn't usually work very well. Most companies don't have liquid debt. A lot of debt's privately placed, so it's not trading in a secondary market. The only time it has a price is right when you first sell it, and then it doesn't ever really have a secondary market up-to-date price. But if you did have a large corporation that had really liquid debt, that would be the easiest way. It's just go out and look at the current debt, what it's selling for, and back out its yield to maturity using your time value money, use your finance calculator, and then you know what's the cost of my debt. And we would assume if the debt that's already outstanding is currently, say, trading a yield to maturity of 5%, that if you went out and issued another bond, they would also require 5% on that. So the assumption there would be Current market price would also be your marginal borrowing cost. So that would be our cost of debt, 5%. The next best way to find cost of debt, if you don't have really liquid debt securities, is estimate it based on the firm's credit rating. We have fairly good data from rating agencies and investment banks on what the current cost of debt is for different rated corporations. So AAA, AA, single A, triple B, double B. Every day there's various different organizations that put out estimates of the cost of capital for those different debt instruments that would be rated that. And most firms, large corporations anyways, pay to get themselves rated, so it's easier to raise capital. If you didn't have a rating, if you were a smaller firm or something, you would have to estimate your own rating. So there's ways to do that. You can come up with an Altman Z-score or something for your firm to try to figure out what would our rating be, so that you can predict ahead of time before you do a debt issue how much it's going to cost you, essentially. And then I put on here, note that interest payments are tax deductible. We'll see that in a second. But let's just do an example here. So I have Coca-Cola. Their current credit rating is AA minus, or I've also seen single A. There's multiple rating agencies. But its last annual report estimated it had a marginal tax rate of 24%, so we'll use that. The Bank of America Merrill Lynch, they put out daily rates that different rated corporations have to pay on their long-term debt. And that's what I've listed here. This is yesterday's, so I tried to use up-to-date information just to keep it a little more interesting. But down here it says estimate Coca-Cola's after-tax cost of debt. Well, the formula I wrote way back up here for the debt portion, it's just this part right here. This part, just the RD, that's the rate you pay on your debt. That's the rate that the investors receive. From your perspective as a corporation or a company, when you're paying on debt, though, we want to consider after-tax cost of debt. Debt payments, interest payments, are tax deductible. They come above taxes on your income statement, and so they're essentially a tax shield. The way you deal with that mathematically is you multiply it by 1 minus the tax rate, and it makes it lower. It's going to make that after-tax cost to you is going to be lower for debt payments than it would be for equity, for example, because if you pay out dividends, you don't get to write those off your taxes. Dividends don't even show up on an income statement. If they do, they would show up after taxes at the very bottom, probably after even net income, but they don't usually show up at all. So because that's one major advantage of issuing debt over equity, is that you get that tax advantage. You get a tax shield on all your interest payments. So if we go down here for Coca-Cola, for starters, let's find the cost that the investor is going to receive. So this is the return the investor expects to get. If we're AA minus, we're somewhere between AA and A, which isn't that big a difference. There's 2.12% on AA and 2.5. I have a little chart here that kind of graphically shows these. So the difference is between these two bars. So when you look at it in perspective of all the different ratings, it's really a pretty small margin. What I did was kind of just pick a number in between those. I went with 2.25%. It's a little closer to the AA than the A. But these cost of capital measures are not exact by any means at all. You're trying to get a ballpark figure, which means you're trying to get pretty close to your actual cost of capital, but it's not an exact science. So in this case, I went with 2.25%. That'd be the return the investors would receive if they bought our bonds at Coca-Cola, if we were Coca-Cola. But then you need to multiply it by 1 minus the tax rate, because from our perspective, we get to write those off our taxes, so we pay a little bit smaller tax bill. So it's like a little cash inflow for us. And it makes our actual cost to issue those long-term bonds only 1.71%, which is pretty cheap. All right, let's move on to the cost of equity. Multiple ways to calculate the cost of equity. It's quite a bit more difficult than calculating the cost of debt because equity doesn't have predefined cash flows. So the best approach, in my opinion, it is the discounted cash flow approach, which I normally call the constant growth dividend model approach. It's the same thing we did from the last chapter. So we had that formula, and I'm going to show it to you again here in a second, but it was returns equal dividend yields plus capital gains, or dividend yield plus growth in dividends. So it was current income plus growth, basically. And we're going to use that to estimate the expected return on the stock, and that's essentially our cost of our stock. That's the return we have to pay out when we borrow money in the stock market. We could also use the capital asset pricing model approach. This tends to be a little sporadic. You can get some really strange results because there's lots of assumptions that go into the CAPM model that can drastically change the output. What's the expected return on the market? What's beta? Beta, when we measure beta, do we measure it over the last 5 years, over the last 3 months? Do we use daily returns, monthly returns? All those different possible inputs into the CAPM can lead to different results of your cost of your equity, whereas the discounted cash flow approach tends to be a little, first off, it's a little more intuitive. It's straightforward. You're not worrying about this strange beta thing, which a lot of people don't understand very well, but it also tends to be a lot more stable. You get the same answer even if you change your inputs a little bit. But that's another possibility. And then the third one is in your textbook, but I haven't ever really seen it used or even taught before, but it's what they call the bond yield versus risk, plus risk premium approach, which is we're going to look at the cost that we paid on our bonds, which was 2.25%, and we're going to add some risk premium. The problem is, where do you come up with that risk premium? The CAPM tries to solve mathematically for what the risk premium should be, but in this one we really don't have any theory behind what that risk premium should be. But we'll talk about it in here as a possible third method. These measuring the cost of equity, most of the time in practice, you can pick whatever method you think works best in the particular situation, and sometimes one method might work best than another. There's other times where you have to do all three methods. For example, natural monopolies and banks, companies like that, they, at least in the US, they have to report their cost of equity to regulators, and so they'll have to go through all these different approaches and report them to the regulators. Is this what our cost of equity is? So that, for example, if you're a natural monopoly, they want to know what is the appropriate price you can. If you're an electricity company or something, the regulators like to know you're not making an inordinate large return on your equity, and so if that's true, they'll make you push your prices down. And so companies like that, and banks as well, they'll have to go through and do all these different approaches, and you'd hope that all three approaches come up with the same number. But as we'll see in this example, especially, that's not going to happen. So anyways, we'll go through them all as an exercise. So for starters, we'll look at the discounted cash flow approach. This is the model we used in the last chapter. So returns on equity are a function of two things added together: dividend yield plus growth rate. That growth rate is the growth in dividends, and it's also what we assume the capital gains rate is. So in the last chapter, I put up a chart. Let me see if I still have it over here. That's the wrong one. We'll use that in a second. Here it is. Where I actually went through and estimated the expected return on Coca-Cola. And so we looked at dividends, long-term dividends, and we actually calculated a long-run growth rate on it and all that. So you can go back and look at that lecture if you need it. I just wanted to. So we calculated a long-run growth rate of dividends, we added in the dividend yield, and we got a current expected return on that, on Coca-Cola. So if you did that for yesterday, their current dividend yield is 2.64%. Their long-run dividend growth, I just used a simple long-run average, it's 10.42%. Add those two together, you get 13.06%. So that's our measure of our cost of equity. Meaning for every $1 we issue in equity by issuing new stock, our investors expect 13.06 cents a year that we need to pay them back, either in the form of dividends or in the form of capital gains by reinvesting in the company. It's the discounted cash flow approach. Here's the CAPM approach. I'm running a little low on time on this video, so I'm going to go ahead and pause it, and then I'll see you on the next video.